Hello, everyone. This is Mohammad Akif with Akif CPA, and today we are here to discuss client stories. All right, this is an interesting way to explain what is happening in a tax situation. What are the issues? How can we help you provide solutions? So discuss the issues, discuss the solutions, and then really go from there. Right. So this is one of the series that we have started. Today, I'll be discussing cross-border. So this is US and Canada tax. I've done a lot more videos on business and individual tax. So a lot of the stories that we share, of course, these are all uh, prospect client emails they're sending to uh, to discuss their situation. So we have redacted a lot of the personal information, all the personal information, all the sensitive information. So this is just an idea to discuss a situation. So I'm just discussing a general scenario, discussing the issues within that scenario and the solution, possible solutions for that scenario, right? So this situation might be applicable to you, might not be applicable to you, but it gives you an idea where things need to be, how things need to be, and how to look at things, right? So without any ado, I have done other cross-border series for the client stories, and this is just one of them. Then for the let's get started. Let me share my screen so you can see what I am seeing, and then we can discuss what is happening, the issues, and the solutions. So before we get into any detail, of course, you can shoot us an email, info@akifcpa.com. We can help you with your tax needs. That includes cross-border Canadian, US, business and individuals, and on the US side too. We have a great team in place that can get things done for you. So you can check us out on akifcpa.com. Read about us on Google, read our reviews, and then research about us, right? Research about anybody who you want to work with, find out who they are, and then make your decision. Do your own research. Make sure you find somebody competent. Make sure that you find somebody who knows what they're talking about, and then make sure that they can deliver for you. All right. So without any further ado, let's get started. So let me share my screen. Nope. There you go. Okay. All right. So, hello, Keith. Uh, I hope you're doing well. I'm in between moving from Canada to the United States. I would like to understand the best way forward for my investment accounts in Canada. So that includes TFSA, FHSA, RRSP, and some crypto. Let me know how to proceed further. All right. So this is a really good example of what a common scenario for a lot of Canadians when they're moving to the United States or they're planning to move to the United States. So this could be people living in Toronto, in Vancouver, in Alberta, you name it. They're all the time. There's a lot of movement from north to south, and then we deal with a lot of Canadians who are coming to the United States to work, to live, for family, for different purposes. And then so this is a common scenario for a Canadian when they are moving. Majority times they will have a TFSA, a FHSA. That's a new account, and I'm just gonna make a pen. TFSA, which is RRSP. In some cases, RESP too. We can add that on there as well. And then so what happens when you are trying to move? What happens, right? So the first issue is uh, your retirement investment accounts, right? What happens to those accounts? That's number one when you're trying to move. Number two is the tax filings. That's number two, right? This includes Canadian departure tax returns. And number three is tax planning, right? I would, for this one, I would do tax planning as number two, and then I would discuss tax filings later. So three big big issues with this, right? What happens to your retirements, your investment accounts as a Canadian when you're trying to move to the United States, or when you're in planning, or you have moved? How does the U.S. looks at it? That's another. That's one thing. Of course, what happens on the Canadian side too when you are moving? How the accounts are treated? Are there going to be any tax consequences on those accounts? So taxation on the Canadian side when you're leaving, and then taxation on the US side for those accounts when you're leaving, right? So these are some things that we have to take in consideration. Number two is of course tax planning, right? So once you understand the tax consequence, you have to plan accordingly. So for people who are trying to move, a good time to talk to a cross-border accountant. This is a great time because this is something that I understand for a lot of people. This is the last thing on their mind, and then majority times what happens is they end up moving first and then finding a cross-border accountant later. In this scenario, you lose a lot of planning. You might end up paying extra taxes, additional taxes. Also, there will be additional reporting. So tax planning is the key when you're trying to move. This helps you minimize taxes and also help you minimize reporting. That's the key here, right? It's just not just, hey, you know what, I'm going to pay less taxes. It's also about, what I'm going to file less to. I'm going to report less to, because if you don't need to, you should not be reporting more. We should report as whatever is required, but then if you can do planning, we can minimize it, because in this way you can make your cross-border tax simple, manageable, number two, and then easy. Simple, manageable, and easy, your cross-border taxes once you do tax planning, because otherwise you will be in a pickle for a couple of years trying to figure this out, and then next thing you know, a cross-border accountant, you will always require one for a couple of years. Once you move, if you don't plan it properly, and you will end up paying a lot of professional fees. We don't want that, right? At the same time, taxes and then more reporting. So let's without any further ado, let's talk about what happens to those recurrent. So let's say in this scenario, we are saying this person is leaving Canada for tax purposes, and then they will becoming a U.S. person. So what happens on the Canadian side? So TFSA is a retirement account. Uh, you know, this is they are not subjected to any tax departure, tax, or filing. So TFSA on the Canadian side has no issues. If you leave Canada for tax purposes, if you do depart Canada, there is no tax on TFSA account. So any investment that you have in there are all covered. There will be no additional tax. RRSP, same thing. It's a retirement account. Once you leave, there is no tax on leaving Canada, so you are covered. FHSA, that's relatively a new account. This is for your home purchase. So once you do leave, there is no tax consequences, but you cannot use your account in the future. As a non-resident, we do have limitations. When it comes to FHSA, we have a really good blog on this. I'm going to search and then and show you guys if you can see my screen. See if all right. So let me share this with you real quick. Not sure what happened, but I'm here. Okay, so mm, is this the one? See, okay. All right. So if you see, if you see this, So you can see, so FHSA, of course. So what it is for non-resident, if you already have, you can keep it open. There are limitations. I hope you can see my screen. Okay, let me just close this. Okay, so let me go down. So if you already have one, once you become a non-resident, uh, if you make any withdrawals, there will be a withholding. If you make withdrawals on the FHSA account, there will be withdrawals. You cannot make withdrawals for buying a home, kind of while you are a non-resident. These withdrawals are typically free for residents, but not for non-residents. So once you become a non-resident of Canada, and if you have FHSA, any withdrawals will be taxable. So there is a 25% withholding for non-resident Canadians. Uh, so that is there. So biggest issue with the FHSA is that you cannot use that account once you leave. So if you have the opportunity, I'm not sure how much you saved. If you have the opportunity, that I will try to liquidate. That will be my recommendation. Again, talk to a cross-border accountant, talk to your investment advisor, and see what makes sense for you, because not everybody is going to be in the same position as you are. So, all right. So solution. I mean, so we were discussing the accounts. Oh my goodness. All right. So solution, right? So what happens? Number one is what happened to your accounts. So TFSA, as I mentioned, uh, nothing happens when you leave Canada for tax purposes. Right. All right. So nothing happens. Departure tax. That's what we're talking about. RRSP is also okay. Nothing really happens. FHSA, I just talked about. You can, once you become a non-resident, you do have limitations in terms of how you can use the account, but there is no tax when you leave. Crypto, it is a taxable asset. So if you have crypto, and then if you are leaving Canada for tax purposes, or you're ending your residency on the Canadian side, then there will be a departure tax on the crypto. That includes shares of any other corporations to any non-registered account that you might have. These are all subjected to a departure tax. Any real estate that is Canadian real estate is not subjected to departure tax, but any real estate that is foreign will be subjected to departure tax. So TFSA, FHSA, RSP are all okay when it comes to departure tax. Crypto is not. Shares of corporations or shares of any other companies are not. And then of course the foreign real estate is also not. So that's what happens on the Canadian side. What happens on the US side? That's another issue too, right? So you can move with all these investments and retirement accounts, but what happens on the US side? So US side, TFSA, uh, for for us is a no for a US person, because that's what happens when you start moving, when you start living in the United States. You become a US person because of the residency. You're meeting tax residency rules. So TFSA has no filing or reporting requirements from the IRS specifically, but we look at other accounts to see how this is reported. So some firms will say this is a trust, and some firms will say this is not a trust. Regardless, anything that happens within that TFSA account is, any income that you get, which is interest, dividend, capital gains, you name it, will be reportable and taxable in the US. So the whole point of having a non-taxable account on the Canadian side really goes away when you move to United States with TFSA. So if I could, I mean, of course, depending upon your own personal situation, I will close this account to minimize reporting, to minimize taxes, because on the Canadian side, no tax, but on the US side, there is tax. So and then depending on your bracket on the US side, you might end up paying more taxes. So I want to look at the TFSA account for you. This is something that you want to look at into detail, and then talk to your advisor, talk to your cross-border professional, make a decision. Our recommendation is, if you can, close the TFSA account. RRSP is okay. Crypto, of course, you're paying deposit tax. We have certain rules on the US side. You will pay tax on this whenever you sell on the US side too. So nothing on this side. FHSA, of course, this is again a new account. There is no reporting. On the there's no reporting guidelines from the IRS, so we have to look at other accounts similar to FHSA accounts, and then file returns information based on that. So these are things. So I will work on the TFSA account, and then I will work on the FHSA account before coming to United States, before moving to United States. All right, so that's the issue number one. So when we talk about what happens, the number one issue was what happens on the Canadian side, of course, and then what happens on your side. Based on this, number two issue is the tax planning. So now you do understand what is going on with these retirement and investment accounts. Make sure you do your own tax planning, right? Make sure you talk to a cross-border professional and then your investment advisor. Do planning before you move. Understand how this will work in your favor, and then make the best move uh, accordingly. So not every situation is going to be the similar situation. Everyone's going to have different. In some cases, I've seen TFSA with more than 100,000. In some cases, I've seen $500, even less than that. So it really comes down to you, and then how are you looking things? What is your portfolio? So not everything might be applicable to you when we're discussing this situation in this video. So number one, understanding rules on the Canadian side for the investment and for retirement. When you're leaving, understanding rules on the US side for the same accounts, all these Canadian accounts, and then doing tax planning. That's number two. Doing tax planning based on your understanding. So no, once you do it, do tax planning. All right. And number three is tax filing. So first year of filing, when you're moving from Canada to United States, the year that you move is going to be the most complicated year. You're ending one side and then you're starting a new side. US rules are not similar to Canadian rules, and the Canadian rules are not similar to US tax rules. So guys, make sure you find someone that can help you. I know there, Canadians, as a Canadian, you Canadians are DIY people, want to do stuff their own. But I am recommending that you find a cross-border professionals. I've seen Canadians using Canadian accountants for their Canadian tax returns, and then finding a US accountant. And then I'll tell you more than 90% of the time, we find so many mistakes because the Canadian accountant doesn't understand the US rules, the US tax rules, the US tax guidance. And then the US accountant does not understand how the Canadian investments and retirements are taxed in the US. So you find somebody who is competent. Yes, it will be costly, but it's a first time investment. So it's a one time investment where you can understand things, and from there on, once you understand it, you can look at things. If you can do it on your own. But the first year, I would recommend getting somebody who is on the cross-border side, who understands cross-border taxation, and then they can help you. It is very important because I've seen people missing a lot of information returns, F bars, 8938. Sometimes the attribution rules for the corporations, right? There's so many things happening. And then so the penalties on the US side are huge. You don't want to miss those forms. In some cases, half the account value. We don't want this. Understand the requirement, follow those requirements, and file the returns. But the only way you can do this if you talk to someone who's competent, who understands what they're doing, and who understand both sides of the border. So it doesn't have to be us. Find some other cross-border firm that can really help you, right? So the first year accounting, make sure you find first year of your move. Make sure you find a good cross-border accountant. Anything, if you are in some similar situation, you're planning to move, or you have moved, and this is the same scenario that you're going through, shoot us an email, info@akifcpa.com, and we can help you with your US and Canadian tax cross-border needs. We are help you, again, info@akifcpa.com for your Canadian US cross-border tax filings. Thank you.